Good day, everyone. It's Dr. K coming at you from London, Gil Morales over in Playa del Rey, and we have an interesting market upon us. The channel, that narrow channel that these major indices have been forming, have now broken out to the upside. The NASDAQ's looking pretty good here. The S&P is also looking pretty good at new highs. The Russell 2000 is just, I think, scraping new highs now. And we also have a number of names that are confirming this price action in the indices. We, of course, have LinkedIn with the gap up. We have Ruckus, RKUS, that's up nicely. Commvault continues higher, and so on. So it's looking like a decent reaction on behalf of some of the leading stocks that we're seeing this morning. We have, I think, what is that, the name? The Association of the Investors, individual investors are at quite a bullish stance right now, so that's from a contrarian view. That would be bearish for the markets. But again, sometimes these environments can continue their uptrend and go more and more overbought with increasing bullish sentiment as the trend continues higher. So we just continue to watch the trend, stay with the trend. If you have stocks that have buckled under, always adhere to your sell stops. There have been a number of good names that have done just that. And then we also have had some names like DDD, which came off quite hard on big volume, bounced off its 50-day, and then now is resumed its bounce just beyond the midpoint of the drop. So as I wrote earlier today, this is the kind of stock that looks like it's acting right, but if you don't have a position in it, wait for the pocket pivot or wait for the base to form and then buy the breakout. In other words, we're probably not going to see a buy point in this for at least a number of days since it's come straight up off the bottom there. Keep in mind that this stock tends to often do that. It did this in November, mid-November. It went straight down through the 50-day, then it came right back up, and then it did offer a pocket pivot on November 26th. However, you could have taken a small position. It's a little bit of a lower quality one because it's coming straight off the bottom. And that said, there was after that point, you had another shot at buying this. That would be on December 17th. If you let's see, wait, is that right? 1, 2. December no, that would be December. No, actually, that wouldn't be because that.
You're talking about here. Right here. I think is what you're talking about. That was actually January, December 31st. Right?
No, wait a minute. I'm looking at. Now, actually, the next time there was a buyable gap up on January 2nd.
Right here. Yeah.
Yeah.
And you came down and you undercut that, but you bounced off the 50-day moving.
Right. So you could have bought a small position on November 26th, just seeing it's a little bit you know that the stock's a bit erratic. So if you're buying it on strength like that, you could expect a pullback of some magnitude. It did pull back, but it wasn't enough probably to shake you out, so that it would go higher, and you could buy your second position on the viable gap up day. And then since then, unfortunately, it's come off very hard. So to sell on that kind of downward volume that began at the end of January is not a bad course of action to take. Also, that it violated its 10-day after obeying its 10-day for at least 7 weeks. So you would be selling on the 10-day violation, and now it's just waiting for the next pocket pivot or some such buy signal in the stock. But all that to be said, if you bought on in November and then in early January, your average cost would be probably somewhere around 50, and then when you sold on the 10-day violation a few weeks later, you'd probably be up 18% on the position. So not too bad, especially in this kind of market environment where things can be quite tricky.
Yeah, tell me about it. My own experience, Dr. K, trading is that you buy a stock, and a lot of times, well, when I buy a stock, I want to see it make some progress for me after I buy it. In other words, you buy it in a good position, the stock should either, if it's pulling back lightly, it should find some support and then turn around and hit higher. And a lot of these things, what they're doing, you talk about a pocket pivot, say in this ruckus, but that's a V-shaped pocket pivot, and you're coming straight up off of this downward pattern, and that's a very difficult pattern to buy in a very thin stock like Ruckus Wireless. And of course the situation with Triple D is also one that will cause you to tear your hair out, because when you see this sort of heavy volume in a stock, that's generally a big warning sign. And of course it comes down here and bounces off the 50 days, so your only chance here would be to buy into the stock on the pullback to the 50-day. And so it does get a little bit, shall I say, frustrating in that you get this choppy action, and stocks will start to look like they're flaking out. NSM was another one, right? And that looked, it just flaking, and all of a sudden, boom, it comes back up. I was even noticing, people had some issues. They got stopped out of this one yesterday. And I got to tell you, if I had owned this, I probably would have gotten stopped out as well. I know that we bought a little bit of it in here when it's just above 20. And then it does this big flip out, and there's like 150,000 shares of stock crossing, like somebody's unloading the thing and there's something wrong with it. And, then it drifts back up just above 20, and so I just sell it there. And so I say to myself, I'm not going to deal with this sort of situation. And, of course, that assessment, I think, is confirmed on the earnings, because that's a huge swing like that. And it's not like you have this massive volume spike. It's a lighter volume spike than you had here. Up at this peak, and so it becomes hard to deal with some of these positions. And I think all you can do is try to hold your ground and stick to your stops, knowing that it doesn't really require you to own every single stock forever in a market that's moving around and swinging around. In my experience, the biggest leading stocks that I bought, where I made the most money, I bought them a month or two generally, except for 1999, where you remember that, Dr. K, when we went long in October right away, and boom, everything is off to the races. But in this environment, it reminds me more of other periods where I'm actually finally finding a big leader several weeks, even a couple of months after the follow-through day. And I always remember 1995, when you had a follow-through day in December of 1994, and then there was another follow-through day, as I recall, in early February of 1995. I didn't find C-Cube Microsystems until May, and by the end of the year I was up 525% after dropping 32%. So, in my mind, it's really a matter of finding that one stock that's going to make you a lot of money on the upside. And maybe is LinkedIn one of those stocks. And here, let's look at the weekly chart. It's just getting started here. And a big gap up, and so you're really just starting to come out of space. So if you buy it here, you're using the 140 low. I think it's exactly 140.13 as your stop. And so I think how would you handle this right now, Dr. K? Would you buy this right here, right now, or would you see if it drifts in closer to 140?
Well, here's the thing. It depends on what I do. Doesn't matter, because everyone's got different risk tolerance levels.
Exactly.
And so we're at about 147, and the low is about 140. So if I were to give this 2% porosity, that means I'm basically risking, buying at this level, I'm risking about 6.8%. Now, I think for many people that's okay. If you want to risk 6.8% on your trade. And also, it is a viable gap up on a good earnings report. So, yeah, I'd probably take a small position here and then round out my position should it retrace during the rest of the day or in ensuing days. I mean, it's very possible the next few days it might have a pullback closer to the low of the gap up day. That pullback may be due to just investors thinking it's getting ahead of itself on the gap up, or it could also be due to general market weakness. But nevertheless, the market often gives you a second and third chance to get in to a viable gap up at a better price. But don't let that make you stay away from buying it here. I don't think it's a bad decision to buy a starter position here. So a starter position could be a half-size position to some people. Right.
And I got to tell you, it's somewhat frustrating. If you own a 10% position, you see this thing kind of move up, because it's really only adding 1.8 or 2% to your overall portfolio, which to me is just milk fat. I was on TV yesterday you're talking about LinkedIn. They want to know what I thought. You may notice I hedged myself. I said that I thought the company would report a better than expected number. I did not say that I thought it would necessarily go up. So I didn't want to stick my neck out too far. Of course, today I look smart, but as far as I'm concerned, I would have been really smart if I had had a 50% position in the stock going into earnings and making a big pop today. But that said, I'll have to go back to 2004 when I owned Apple, and back then I was long a whopping like 5% position, is 50,000 shares, but it was a 5% position for that particular portfolio, and I saw the stock gap up 15%. This is in, I believe, October 13th, 2004, and the stock gapped up, and then I loaded the boat and went into about another 300,000 shares very quickly on the gap up, and then it had a big move. So I'm interested more in, I'm not so worried about whether I own the stock before the earnings or after the earnings or what. I'm just interested if this viable gap up means that this stock can go to 200, 250 or beyond, and that's really the key. And I think if you're looking to buy it, you can, like Dr. K said, take a starter position here. You can hang out and see if it drifts in a little bit. If you're a little nervous about buying it up here. The one thing I would note about the market is that this morning we've got light volume. You're running about 18% lighter on the NYSE and 10% lighter on the NASDAQ, and you're breaking out of this uptrend channel, or at least you're trying to, because really if you look at the NASDAQ index here, where's my handy dandy little drawing pen? I know you're here somewhere. There he is. And you see this, and you're really trying to come up to the top, and you're doing it on light volume, which to me looks a little bit suspicious. So I'm wondering whether this move today will turn out to be a bull trap, and it wouldn't surprise me because I like to call this market an ugly duckling market. When things look really good, you don't buy them. I mean, look at a stock, for example, like Coors, looking really good on a breakout up here, and of course it reverses, comes all the way down. You get a little pocket pivot, but now you got to decide if you want to own this stock, where do you own it going into earnings, and how much? And again, you get back to the same issue. Would you rather just wait for a viable gap up to move in on the stock when you have a more certain buy point? Because it is somewhat erratic, and so that makes things a little bit of a problem. But I would watch today's action because I'm a little suspicious of this, individual stocks action notwithstanding, such as LinkedIn, but I'm a little suspicious of this move up in the indexes. Of course, the NASDAQ composite is up big. What is that? Is that because of Apple, Dr. K, or is that because of LinkedIn? Is LinkedIn a big part of the NASDAQ these days?
Well, it's not a huge part, but I think that the action in LinkedIn bodes well for techs in general. So because the NASDAQ's tech heavy, there's a number of stocks that are contributing to its move.
Yeah, that's true. One thing I wanted to point out, I'm just going to show this chart. This is from DecisionPoint.com, and Carl Swenlin runs this site. Carl's very generous about letting people use his stuff, every once in a while, as long as you give him credit. And so this is copyright 2013, DecisionPoint.com, and used with their permission. Carl lets me use his stuff on occasion, either in reports we send out or whatever, any presentation we're making, without making a big stink out of it, unlike other people we know out there that we won't talk about. But this is an interesting chart because this is a relatively new sentiment survey, and it comes from the National Association of Active Investment Managers, and this is available on DecisionPoint.com, which is a great site, I think, for a lot of stuff like this. But it shows you the percentage invested that these active money managers are in right now in terms of their exposure to the market overall. It's a survey of 40 member firms who are active money managers and are asked each week to provide a number which represents their overall equity exposure at the market close on Wednesday. So what you're seeing here is, Dr. K, you hear me okay?
You're coming in fine.
Okay, somebody says lost sound. A lot of times, you guys, that's your own internet. So, pony up for some good internet service. That's all I have to say. Speaking of that, we've got Bill Griffiths. This internet service is out today, which is not the most exciting thing you want to see. But anyways, especially on a day when we're recording the webinar. But we are recording it. I'm recording it, and we'll put it up later. It may take a little longer, just so you know, you guys. But you can see these guys now are over 100% invested last week. So they're on margin. And you notice what happens. It's a pretty predictable pattern. They get, as the market goes up, they get more and more invested. Now notice it starts to roll over here. Their peak is here, but the market corrects, and then it does go higher. And then you see this crack here, and then it turns red. You see this tiny little red bar showing you that their net exposure is short, is on the short side. And again here, this is probably the only time they were right. And so I'm going to guess it's like 1 or 2 managers, and the rest are very minimally invested. But you can see as the market comes down, you get near a low, they get very, say, underinvested. Here's another point where they got short right at the bottom on balance. But you can see as you march higher and they get more and more invested, you're getting into a position where there have been market tops. Now this survey has not been around. It's only been around, what, 5 or 6 years, so it's not like it's got a lot of history behind it. But I think it's interesting that that's what's going on now, and you are seeing this very huge bullish sentiment in the individual investor, what is that, the American Association of Individual Investors, as you cited, Dr. K, and also the Investors Intelligence survey of money managers. But anyway, so that's basically what's going on. So, you know, if you got stocks that are working and you're able to hang on through a lot of this volatility, then maybe you're making a little bit of progress. But it seems like, you know, we bought some stocks and we've gotten stopped out on them, and they whip you in and out, and it gets a little problematic at times. So it's not the easiest market in the world to be trading, but the index is continuing to move higher, and so those of you who are using the market direction model are showing steady progress. But you know, you see these funky days where you start running into some selling, and you notice you're getting a little looser in here. So just see how today pans out, but not necessarily breaking down just yet today. So anyways, let's see, what do we want to do? You want to talk about, just do some questions here? I mean, we've gone over some of the major stocks. Let's go through some questions so we have plenty of time for that, because we've got a lot of them today. And I'm sure you'll get to some other stocks that we've been looking at. Yep, FLT, BGU. Is that a BGU, Dr. K?
Would be. Seen this one before, and it's been trading quite tight, and it's got a good earnings report. You know, it had one way back in August, but yeah, this one, I mean, it looks like it's doing everything right. You know, it's a little ahead of itself right now, but we could report on it, and just with the caveat that, you know, you probably don't want to be buying it all the way up here.
No, but it would be a viable gap. If you buy close to the low at 64.07, then you'd probably be in a decent position. LinkedIn, we've already gone over at length. In your new book, you're writing about pyramiding one SLV position in 2011. My question, you're writing about your own research that has shown that it does make sense to buy more every 10% stock value increase. Can you explain this position sizing and managing in more detail? When do you use this automatic position increasing method? That there's really not much more detail to offer. That was just the decision that was made, that we would add to the SLV as it went up every 10%. And it's kind of a, you know, you can look at the SLV and notice how it moves, but I don't know necessarily if there's any detailed research per se that caused us to use that rule. Dr. K, you want to comment on that? Let's go back to that wonderful year of 2011.
You can use all kinds of pyramiding and position sizing techniques, but they have to be in keeping with your risk tolerance levels. So in other words, you don't get too top heavy in the stock, or you miss out on the meat of the move because you weren't exposed enough. And that's up to every investor to determine. I mean, one such style is to say, okay, I'm going to buy X% more. I'm going to add X% more to my position every time the stock goes up Y%. And those percentages, the Y% really should be dependent on the volatility of the stock. So if the stock is very volatile, and, well, I should say the Y% should be dependent on the really the momentum of the move. So it's a high momentum stock, say with relative strength 99, then assigning a 10%, assigning a pyramid every time the stock moves 10% might be too frequent, and you might find yourself top heavy in the stock too quickly. So you have to figure out that on your own based on the stock chart, where you want to assign it. The way I figured out the 10% on the SLV was just based on the nature of the prior move, and when it goes in an uptrend, what it does. With something like GLD, which is typically half the momentum, or sometimes 1/3 of the momentum, you tighten that by saying, okay, instead of every 10% of the move, I'm going to add to GLD every 7% of the move, for instance. And you can do this with stocks. You can use the 7-week rule in conjunction with pyramiding strategies, so that I can continue to buy the stock higher, even if it doesn't offer any new buy points on the way up. Now, fortunately, it usually does. If it's a good stock, it's got pocket pivots along the way. So I generally default to that. I generally default to adding to my position on pocket pivot or breakout or viable gap up buy points. But it's certainly viable to go ahead and just assign a percentage, adding a certain percentage to your stock position every time the stock moves up a certain percent. There's nothing wrong with that. And it actually, the advantage there is that if the stock offers no buy points until much later, your average cost is going to be lower in that case. And the disadvantage, of course, is that you're just adding to the position based on the upward move a stock makes, and so that might mean you end up with a higher average cost than, say, if the best buy points occurred earlier in the pattern. So again, it's a balancing act, and everyone has to figure out what works best for their style.
Yeah, and it's not really a holy grail. I know everybody's always looking for the holy grail of investing, but that was the one that we decided to use during that period based on the way we could eyeball the action in the SLV, which is pretty volatile, and that's what we decided to use, and it worked pretty well. Now, we could also use one where we average up every 5% because the move, was just pretty parabolic by this point, by the end of it, and so it's pretty simple to use that. But it's just an example of how you decide on what sort of system you're going to use, and then you use it and you stick to it, and by doing that, you're able to achieve a nice gain when the thing moves in your favor. Now, if we had been adding to silver, in the same manner more recently, and up here, I believe we were doing the same thing. Let me see, back in here when you had this move, and then we got smacked pretty good on this breakdown. So it's not like it works every time, and you have to be implementing a stop. And a lot of times, let's say we bought here somewhere or bought in here, and then we went up 10% and we added again in here, and then it goes up another 10% and we're adding here. If we start getting underwater on that position here, we may cut this back very quickly based on the huge volume breakdown right here, and back away. So there's no magic to adding the 10%, every 10% up, or the same number of shares every 10% up. It just happened to work pretty well that time around, and we were grateful for it because it didn't work so well during other periods, but we didn't use the same scheme other times around. We were actually operating on the basis of buy points and being a little more cautious, given the fact that there was in silver at the time a lot of overhead. In fact, I should be using a different chart. There was a lot of overhead. On this move, there's still overhead on the left side of the pattern, and that figures into the context of it all. Somebody asked us a question that I guess requires a crystal ball rather, which I guess, do crystal balls, do they have lead in them? Not silver. But Comball, is it going to have a pocket pivot today? I don't know. Like I told you guys before, I traded in my crystal ball for a new Fender Stratocaster, and so I don't have my crystal ball anymore, so I can't tell you whether or not it's going to. If it did, Dr. K, let's say close up on upside volume that was heavier than or higher than any down volume over the prior 10 days, which tells you that it would need to exceed this bar here, which is volume of 947,795 shares, then if it did exceed that, then would that be a pocket pivot today moving back up through the 10-day, Dr. K?
Yeah, it certainly would, and given the time of day, 2 hours in the trading day, it's a tough call. It's a close call whether it's going to actually be able to exceed that volume level. So we'll keep an eye on it. What I usually do is stocks like this as I volume track them. So as it gets closer to, I'm going to put a volume alert probably at around 500,000, because sometimes these things, their volume increases during the day as they move higher. So it's good to just keep an eye on the volume in incremental jumps.
Yeah, and watch the Dow here. The S&P and the Dow are starting to kick in a little bit. PBF, what is PBF? PBF Energy. Okay, I'm not sure why anyone would ask about this stock. What are we supposed to tell you? The stock's in a sharp uptrend, so there's really nothing, no buy points, and it's going crazy. Is it a climax top? Too soon in the stock's move for it to be a climax top, but you know, you really can't buy it here, to tell you the truth. So, but looking good. So if you own it, kudos to you, whoever asked that question. Google, you know, you had a gap up here. Now, Dr. K, you didn't think this was a viable gap up, and I didn't either at the time. But you know what? It turned out to be one. And what's your take on the stock now?
Well, I mean, again, I think what we said originally was it's generally what we've been saying, and I still would say this. It tends to be somewhat of a slower name because it's matured over time, and so you know it's certainly viable to buy on that day. It's just that we're more interested generally in faster names, and you know it's possible that this thing is you'll get 15%, 20%, 25% move over the ensuing weeks out of it, but
yeah,
and that's a perfectly good return, especially in this market environment. So for some people, this might be an acceptable stock to have bought on that day. But again, it had good earnings. The prior earnings wasn't good. It kind of balanced out the pattern a bit. But again, it's a viable buy point that occurred on the 23rd of January.
Yeah. I got to tell you, instead of messing around with some of these wilder, thinner things like NSM and HLSS and Triple D and whatnot, I almost wish I just bought Google because that's a nice, coherent move higher. You got a breakout here through a sort of a cup base. You call it a cup with a handle. Here it is on the weekly chart, and it just consistently moved higher, held the 10 days. So this one's acted a lot better. But I think you're seeing money coming into the market that needs to get invested pretty quick, and I think Google presents that sort of situation that institutions like.
It could easily, as it tends to take 3 steps forward and 2.5 steps back. So
Yeah.
where it is right now, I mean, I wouldn't be surprised to see this retrace maybe in the ensuing weeks all the way back to the 50-day. In other words, making it, again, as kind of a slower moving stock. And those with less patience would probably jump out of it and not continue to sit in the name. And, one just has to look at the weekly chart on Google, and you'll see what I mean. I mean, it just generally doesn't like to trend more than a brief period of time. And so the question is, is it going to actually finally, are we going to get a good trend out of this stock? Based on its pricing history, probably not. I mean, unless something really material has changed for the company, but I don't see that on a fundamental basis, any drastic material change where they're coming out with some killer technology that's going to revolutionize the marketplace. They just do everything really, really well. That's why they are the market. They have the market cap they do, and that's why they continue to move higher in their price. But that higher move is done in a very begrudging way because, I mean, if you go all the way back to the end of 2009, they're really they're only a little bit higher than they were at the end of 2009.
Yeah. But they're, I mean, I think, well, I don't know what's causing it to continue to move higher. What is the killer app that the market sees here, Dr. K? Do you think there's anything, or is it just money moving into a big cap steady leader that's a leader on a number of fronts now, even the leader in smartphones as well? So
yeah, it's a bit of a safer stock. If you want to be in a tech name, it certainly is a safer tech stock, and there's a number of those, and so obviously big institutional money needs to find a place for it. So again, I don't. If this uptrend continues in a nice way, then it'll be what we something that we saw in August and September. But then, as you can see, that August and September move was canceled out very quickly in one day on October 18th. So
yeah,
it's not the. I say it's a safer play in the terms of holding this thing for a long haul. But since we don't really do that, it doesn't get my eye as nearly as much as some of the other names, which pose a lot more upside.
People asking about Amazon. I think Amazon is setting up to possibly break down through the 50-day moving average. And I think if you did have even a short-term correction in the market, it would probably break down. A lot of bizarre action around earnings, and of course the big gap up after earnings that got sold into, and now you're trying to hold the 50-day. You flipped underneath it yesterday. And to me, it looks like it's trying to break down through here. I don't think I would want to be a buyer at the very least. But I think potentially it's shortable here if you see, I mean, even if you don't see the market roll over, because I do have a small short position in it, and it's actually coming in today, and every time it bounces up into the 10-day line up here, I've been putting out pieces, and it looks like it may roll over. If it does, then that's going to be a late-stage failure, but we'll see how this week pans out. I don't see any real volume on the weekly bar this week. If there was, it might be supporting action along the 50-day moving average, the 10-week on the daily chart, but I don't think I would buy it on the basis of some of this action. But that said, you know, this is an ugly duckling market, and who knows, maybe this thing turns around and goes higher. I don't know. If you really like the story and you want to buy the stock, you could always buy it using the 50-day moving average as your downside stop and see how that goes. But, you know, it's a little funky. So I should also, the same person asked the question, why not start the webinar at 9 or 10 a.m. Pacific time when the market is less volatile? Dr. K, is there a time of the day when the market is less volatile? I don't really know. We generally schedule these webinars around our own schedule because, in case you didn't know, we don't spend the entire day just seeking to talk about the market to everybody. We spend a lot of our time trading and dealing with our own portfolios, so that's our primary activity, and we schedule the webinars around our own very busy schedules, so that's really how that works. We're not trying to come up with some optimal time of the day, and I don't even think there is an optimal time of the day, right, Dr. K?
Well, the most volatile time is going to be the first and last hour of trade, and we never schedule webinars during the first or last hour of trade.
Right, and sometimes it can be a key time of the day when we're coming in. It just works out that way. Someone asked about Digital Globe. You know, they're coming out with earnings at the end of the month. All the stock is doing, it's doing nothing different. It's just going sideways. There's nothing really to say other than it's just going sideways. I don't see anything that indicates it's necessarily in trouble. You have some nice blue volume spikes in the daily chart. Pocket pivots are in the pattern, and it's holding up. But, of course, you would use the 50-day as your stop, not the 10-day, because it does not show a tendency really to hold the 10-day. I don't think you fail here, and you haven't held it for 7 weeks or more. So I think the situation here is that you're looking at a stock that's just going sideways, and it's probably going to do something on earnings. And if you do own any going into earnings and it breaks down, then you'll obviously be upset. And if it gaps up, you probably will not own enough. So you're damned if you do, you're damned if you don't. All you can do with this is, if you hold a position or have a position on any of these pocket pivots, there's no reason to be blown out at this point. So just hang it out. Can you please comment on NCR? NCR is gapping up, but there's nothing. I mean, this is a big computer company growing earnings at a whopping 9%. So it's nothing we're really interested. But technically, it's trying to gap up and out of here, but not something we would buy. VRX, that's actually a stock we own. And we've owned it, I think, since buying it somewhere down in here on these pocket pivots. And it's just slowly trucked higher and actually been a very quiet leader. And it continues to act well. Now, I don't think, let me see here. Are we using the 10-day moving average as our stop on this one, Dr. K?
Yeah, I mean, if at any point in time it hasn't violated the 7-week, then you switch to using the 10-day. But it did violate it on this December 31st. So then you're switching to the day.
Yeah, so now, but that's way down here, so that's a good 10% lower. So don't really like that. But, you know, they come out with earnings. It's moving higher on lighter volume here, and, you know, I get nervous. Fortunately, we own it closer to, I think, under 60. And I just get nervous that you're going to see it crack, you know, on earnings or something. But, you know, that's just my own bogeyman coming to haunt me on that one. But it's acting okay. We'll just see what happens after earnings. We talked about silver and gold, or no, not really. I mean, silver is just hanging out right here. And you have this pocket pivot, but as I see it, that's a little bit premature to buy into because of the V-shapedness of it. And so what happens, though, is you just get it moving sideways. The CME today, this morning, actually announced that they are lowering margin requirements for gold and silver, and they have ticked up a little bit today. I think silver only, though. Gold is off a couple of bucks, but nothing major. And I think they're just hanging out, and we'll see what happens. But I would like to see a more definitive buy point in the silver after this one, and so another one coming up, and I'd feel more comfortable about calling a new uptrend in the metals. Other than that, right now they're just hanging out. I mean, we nibbled on a little bit in here, but now it's breaking down here, so it's not clear whether that's going to end up just being punted, So someone says, I bought the silver pocket pivot on January 30th. With your more positive view on the stock market, would you rotate out of this risk-off name? I don't know. Would I rotate? I don't know. It depends how much, whether I wanted to sit with a position or not. If it's not doing anything for you, I don't see any reason to be owning it, frankly. VMware, I think VMware is shortable on this, inverted or bear flag, and it's rallying up to the top of the range. So this is pretty easy because you can short it here and stop out at 80 at the peak of the range, which I think is $80 even. Looks pretty weak, and it hasn't really been able to do anything despite the market continuing to go higher. So it still looks pretty feeble in my book, and as far as I'm concerned, it is a short, especially if you see if the market corrects, even if it goes into short-term correction, you could probably see it break down to the lows. So, but it looks pretty weak. BlackBerry is not a short. That thing's so far down there, I can't tell you what it's going to do. It's all over the place, down, up, down. So it's not really in a position where you would short it. And the time to short BlackBerry, or Research in Motion, as it was once called, was a long time ago. So that's sort of off the table as a short in my view. Do you see DD getting momentum from XONE's IPO action and therefore likely not a sustainable direction? I mean, it might be. You get that X, what is the name of that one? X1? They're mostly an industrial 3D printer. It might be. And also they announced a 3-for-2 split, which always gets everybody all excited, but in my view, it doesn't really create anything material. And I think it's just a matter of waiting to see what the stock does on earnings. Now, if you argue that this was sort of a short-term climactic type of move, not necessarily a final and ultimate climactic top, but a short-term climactic move, this sort of V-shaped action, it's prone to failure, and you would need to see the stock settle down, I think, before you would want to be buying it. But it's possible it could be getting some good press from the X1 IPO. There is always that sympathy play. You see it all the time. But can you conclude that the action, this isn't sustainable? Yes or no? I don't know. What do you think? Is it sustainable, Dr. K? You want to flip a coin?
Yeah, exactly.
Yeah. So
I mean, so far the overall trend is up. So if the market goes higher, this will probably continue higher, and therefore probably sustainable. It's market dependent, really. But as far as buying it here, it can just as easily retrace. So I'd wait for a proper buy point.
Yeah, I think people ask about InvenSense, and somebody asked about it a couple of weeks ago, and we kind of poo-pooed it. But I do like the fact that, number one, we talked about this a couple of weeks ago, the SOX and the semiconductors have been trying to make a turn out of here. And you see it, say, in the SOX L, is that a 2X? The SOX is, what is this, 2X or 3X or something? I don't know, some crazy. But it's continuing to move higher. Yeah. And so 3X. You look around for semiconductors, and a lot of them have weak EPS strengths or weak relative strengths, and InvenSense does have a weak relative strength. It's only a 54, but I'm going to tell you something from my days at O'Neill. When in 2003, we saw a lot of we were thrown off by the market's action because a lot of the stocks that were leading were stocks that had low relative strengths. I think Amazon at the time we were buying it had like a 63 or a 68 relative strength. And all of that was the genesis of the composite rating, which was Bill's idea, and Mike Webster tested it and did a lot of testing for a year or so before they got it to work really well. And the intention of the composite rating was to identify stocks that were deficient in other ratings, based on the fact that you're coming off of a very low or very, very sharp sell-off in the market. So you had a bear market from 2000 to 2002, and there's a very steep and severe bear market, and a lot of the stocks coming up were junk off the bottom with 60, relative strengths. And so that threw us for a while, and the composite rating was created to help work around that. And in fact, if you look at InvenSense, let me get my chart straightened out here. I mean, it has a 91 composite rating right now, so it's actually, in the top 10% there. And the stock's going sideways in a flag formation. If you look at this, it's trying to come up off the lows. I like the fact that they're turning earnings around. I think they have some futuristic chips, motion sensory chips. If you can go on seekingalpha.com, you can read all about it. There's a lot of articles about it there and what they're doing. And the company does continue to postulate, as they say, that eventually every smartphone maker will be a customer of theirs by necessity. And that would seem to imply that Apple is a potential customer. And if Apple becomes a customer, that's huge, huge for the company. And I think that could drive higher growth. I think earnings were up, 46% in the most recent quarter. They're going to be up 100 estimated in the next quarter. And the stock seems to be acting well. You're seeing some institutions come in. I've noticed some of the Fidelity funds are starting to move into the stock down here. And a good friend of ours who buys stocks, and he's owned Tractor Supply for a long time. He has a cost basis of somewhere around 20-something cents. And he buys these stocks on the basis of their balance sheets, and InvenSense has a pristine balance sheet, no debt, which is unusual for a semiconductor, which usually have a lot of capital costs, and so they're financing all that. But InvenSense is a fabless semiconductor. In other words, they don't own any factories, so where they build the chips. So that's setting up, and I think you're seeing it now in this sort of flag, a little 2-week flag here. So you're looking and waiting to see if you get a pocket pivot up through the 10-day. I think if you see it pull down into the lower, 1450 or lower, you can nibble on it and take an initial position here. It looks okay to me. You like this one, right, Dr. K?
Yeah, this is the other one I like quite a bit because of the story behind it. So it's just a matter of it rounding out its base, I think, and moving higher because the fundamental picture is very strong, and we do see accelerating earnings and sales, and so it's looking interesting. So I'd like to see it clear this sideways move.
Yeah,
right,
but we own a little bit of it, and we'll see how this thing goes. Dr. K and I have always loved InvenSense, probably to our detriment at times. Somebody says Russell 2000 versus QQQ. What is that? Is that the wrestling match of the century? So I don't know. The Russell's been leading, and we know that, and the NASDAQ's trying to play catch up. It looks like to me. So nothing really. I don't know. I don't see anything really different there, other than that the NASDAQ is trying to break out and move higher. But the Russell 2000 is way ahead of the NASDAQ percentage-wise. Did Dr. K just suggest rounding out? I guess this is referring to our discussion of LinkedIn a little while ago. Does Dr. K suggest rounding out one's LinkedIn BGU position by buying below the initial purchase? Did you? Isn't this averaging down?
If you bought it up here, let's say where it's at right now, 147 and change, and you bought your starter position there, so that might be half size position, you can round it out. You can buy the other half as it retraces. It might retrace today, it might retrace in the subsequent days, and it might not retrace at all. But at least you got your half position in, so you're not going to completely miss the move. The other thing is if the stock is viable, it will offer it should offer another buy point as it moves higher.
Right.
But as far as they always say, oh, don't call it dollar cost average down and all that. No, that's a true statement taken in the right context. I mean, you don't want to buy a stock at a cheaper price just because it's cheaper. I mean, it has to look like a constructive pullback, and you also have to have to go into that knowing that your position right now is on the light side and you'd like to increase it. So in this case, with viable gap ups, you can initiate your first position if it's a bit extended, and then buy your second position at a lower cost.
Yeah. Now somebody points out that the volume is lower today, probably because of the storm on the East Coast, and that might be true. Okay, that's a good point. So my wife's mother moved back to New York after living here in California for over 10 years, I'm going to say 12 or 13 years. And as she told me, she had to go back to New York because she felt she is an East Coast girl at heart, and she's moving back as soon as she can get back here. We just got her an apartment around where we live here in Playa del Rey, and she just decided that she may be an East Coast girl, but now that she's in her 70s, she's really a California woman. So she's heading back. So we feel for you guys out on the East Coast with your weather and all, but I'll take California anytime over the East Coast, and I'm sure Dr. K will take London over anywhere. Because even when you have a severe winter in London, it's not that bad, is it, Dr. K?
It's mild in central London, and central London's got its own ecosystem. So
Yeah.
yeah, it's I've never had a really uncomfortable day. I'm a weather wimp being from LA, so yeah, I vouch for London's weather patterns in central London. Step
Yeah.
outside of that, go even 50 minutes outside of that, and the temperature drops 10 degrees at least.
Yeah. Well, Dr. K and I are native Californians, and you know, you get me in the cold, and I don't do so well. You can actually look at pictures on the blog site, I think, of us in New York in January of, what was that, 2011, when we were at the Traders Expo, and we had to go out,
February.
sit outside the NYC when it was like 11 degrees outside, and you just look at my face, and I am not having a good time. I can tell you that much. Somebody asked about Five Below, and all you know for sure is we talked about the pocket pivot 4 days ago. It's a continuation pocket pivot, and stock's holding up okay. You know, it's a teen-targeted discount retailer. They sell things at $5 or less. It's something my daughter would be into, but I don't know if there are any stores around here. But they are planning on adding a lot of stores going forward. So it does look interesting, and the stock's acting pretty well. They completed a secondary offering that was a huge volume, and the thing launched higher. Was well absorbed by the market, and the stock's acting fine. Now you're coming up to the top here. Maybe you run into some resistance and you form another handle, but it looks okay. There's nothing really to think about it. TNA versus TQQQ. Will TQQQ catch up to TNA before the inevitable bear big correction? I don't know. Again, I told you guys I sold my crystal ball for a new Stratocaster, and I think Dr. K sold his for a new piano. So, Gil, please opine on NTI. I know this stock is not your normal type of stock, but I would be interested in your take on the chart pattern. Just mine. How about Dr. K? Northern Tier Energy. You know, there's a number of oil stocks that have been acting well, and so you're just getting a breakout here. It looks like it's occurring on a 161% increase in volume. Last quarter's earnings were up over 2,567%, but next quarters are expected to be minus 62%. So this is a hard one for me to get a handle on, but you know, if you own it, technically there's nothing really to complain about here, so nothing more to say about it. Let's keep going here. We've got another. We'll probably go to about 9:05 since we did start late. We talked about Google already. Would Adobe be considered a pocket pivot? Whoops, too many D's there. Here we go. Adobe, no, you know, we wouldn't look at this because negative 9% earnings growth in the last quarter. It doesn't really have what we're looking for. You know, and it's kind of like, you know, people were always asking us about Akamai for a long time. We never bid on that one just because I thought it was a lower quality leader, you know, and let's take a look at this. And coming out of a weak position in the overall patterns, trying to come up, and you know, 20% growth I guess isn't enough, and it blew apart. So we're not really into stocks that have lousy earnings, and I think Adobe is like that. So I don't know. You know, maybe it goes higher, more junk off the bottom, moving higher, but doesn't really get our blood boiling, we have to admit. Somebody asked a question. Silver futures had down volume equal to the up volume in the pocket pivot last week. Would you avoid the trade now given the price pattern? Well, we already talked about that. My view is if you bought into any of this and it's not doing anything for you, there's no reason to hold it. You could just unload it and wait for a more definitive buy point. Someone asked about, is IBM an over-owned stock? I mean, IBM has been an over-owned stock, or a widely owned Dow stock for a long time. So not really in the same category, because you haven't seen institutions pile into the stock the way you have seen them recently in Apple. So it's a completely different animal altogether. Would you say so, Dr. K?
Yeah, no, absolutely. So you know, it's definitely one of the more matured companies that's you know, not going to be winning any races.
Yeah, VMED was bought out, and people are always, you know, wondering, should they hold it, should they fold it, should they, you know, is it gonna trade up to the $47.87 a share buyout price, and it's a couple of bucks lower, and of course everybody's got to hold out for top dollar, right? And everybody wants to know whether it's going to trade up there. Like I said, we don't have a crystal ball. We sold ours off for more useful things, and maybe it does, maybe it doesn't, but it will trade there if you wait until the buyout occurs. So, you know, if for some reason the buyout is not approved, you know, such as you saw with the Bud merging with somebody and you get whacked, and of course that's going to take the stock back down. So you have to think about that. Is it worth another 2 points for you to take that risk? It doesn't look to me like the deal is going to be, shall we say, negated. So it looks like if you want to hold on for that, go ahead. But think about it. You made a nice gain already in the stock. I think the pocket pivot was down here somewhere. Where was that? Down in here? Somewhere down in here, but well below 40. So you've got a nice gain. You know, if you want to take it, then that capital is free for something else if you want to do something else. But, you know, the only way you know for sure that it's going to get to that price is by waiting for the deal to close and have them exchange your stock. But they're going to exchange another stock, which I think is, what is it, Liberty Global, which is what? Is it this one? Yeah, and so, you know, who knows, once you get that stock, who knows what that one's going to do afterwards. If it was me, I would just take the money and run. So, Fortinet, not a stock we're going to play. You know, it's in a weak position in its weekly chart and not really something we're interested in right now. So, I don't even know, what do the earnings look like, Dr. K? 21%, up from 8% the prior quarter. Doesn't get me excited. Sorry, John.
Yeah, I don't like the pattern either. It's got the gap down and everything as well.
We like your InvenSense better, John. Just to let you know. Dr. K, that's your name, right? In a recent report, you suggested using the 10-day moving average violation as a stop out versus the 50-day moving average. Is there a significant difference in returns and volatility based on your research?
Is there a significant difference in what? In what are they asking?
Is there a significant difference in returns and volatility based on your research?
Returns and volatility?
Yeah, because apparently, well, this person's saying that you suggested using the 10-day moving average violation as a stop-out versus a 50-day moving average. I don't think this person understands the 7-week rule, actually. And using the 7-week rule, you would determine whether you're going to use a 10-day moving average or the 50-day moving average. You don't just arbitrarily decide to use one or the other. So I think that in that case, that's not really a relevant question, because the stock has to tell you which moving average to follow based on the 7-week rule. And if you don't know what that is, just go to our website on the FAQ section and type in 7-week rule, and you will find more than enough information.
They should keep in mind also that the whole premise, when you buy a stock, that doesn't mean you automatically have to use the 7-week rule. I mean, if I buy a stock and it goes back into its base, I'm not going to wait for any moving average violation. I'm just going to sell it, especially if we're in a trending market. I don't want to be holding stocks that are going to slow my portfolio down.
Yeah.
So, you know, always keep that in mind. And that could have been in reference to using the 10-day moving, a violation of the 10-day moving average in the first few days of the purchase. As one possibility. In other words, okay, it didn't go back in the base, but it's dragging along, it's violated the 10-day, yeah, switch out of it and buy something that looks better.
Dr. K, someone's asking, what are your thoughts on RACs going into earnings? My view is the stock was already a stop out, and we discussed this, I think, a couple of weeks ago or maybe last week. I need to take a quick 20-second break here, Dr. K. You want to talk about RACs going into earnings?
Sure. Essentially, you know, you're seeing the retracement back to the 50-day where it got support, but the fact that it did go back to the 50-day is negative action, especially right before earnings. And as we've always said before, with these stocks that are going into earnings, make sure your position size is appropriate, because any of these stocks can lose half their value overnight on a very disappointing report, as we've seen. So keep that in mind. If the stock acts strongly right before the earnings report, that sometimes is a clue that the report might be favorable. But again, that's not a guarantee. So you know, and I would just keep that all in context. And you know, so far this stock looks to me like it's held its ground fairly well. You know, looking at the price action overall since August, when it had a well, it had a viable gap up straight off the bottom after a gap down, and you know, a small position could have been taken there, and then you had a couple other buy points, and then it had the 50-day violation. But since then, it's had renewed buy points. So if you're sitting in profit in the stock, there's nothing wrong with holding it through the earnings report. But as long as you know that your position size is in context with what the stock could do on a bad report.
I'm back. Okay, yeah, you know, this thing violated the 10-day, right? And going into earnings, you know, for all we know, it'll gap up and go higher into earnings the way this market's been acting. So, but I don't think I would own it into earnings. Would you, Dr. K?
No, it's just if you already bought this and you're sitting on a profit and it's the position size isn't too big relative to what you could withstand should the stock gap down on you, then sit through earnings or pare it down a little bit. I mean, and I was just saying I don't like how it's retraced all the way back to the 50-day on some volume there, even though it seems like it's getting support, but that is negative action. So I would weigh that in as well in terms of how much of a position you want to have through the earnings report.
Oops, sorry, didn't mean to bring that. Let me get that out of the way. KKD, it's just going tight sideways. If you look at the weekly chart here, let's make this bigger. Very tight sideways, in a little flag formation, so there's really nothing going on there. It's acting very nicely, so you watch for another buy point coming up through the 10-day moving average, a pocket pivot, which I guess would have to be higher than, let's see, 1, 2, 3, 4, 5. Well, you'd just have to be higher than this volume bar here, which is a mere 1,341,000 shares. So that looks okay. Is ISRG viable based on the gap up pocket pivot? We've talked about this one before, and Dr. K doesn't really like the position here. So far it's acted like, it wants to hold up, and it's going tight sideways here. So I almost say there's not too much wrong in that sense. What do the earnings look like? 13% earnings growth in the most recent quarter. Would you buy the stock, Dr. K? Do you think it's acting okay?
Yeah, ISRG. The problem with the pattern is it's been a bit slow. It had a gap down, or really two gap downs, two big drops, and then it had this gap up, and it's holding tight. So it's being very constructive since it's gap up.
Yeah.
So I would say it very well could offer a pocket pivot once it breaks out of this this small island here. And I'd probably be more comfortable buying the pocket pivot rather than buying it now and sitting, because it sometimes has a tendency to be a bit slow and sluggish. And right now the relative strength is only 58.
Yeah, so I don't know. I wouldn't buy it. It probably means it's going to go higher. Here's Catamaran. This is a stock I've loved to hate, and today it's spinning out. This actually is under some pressure. Is it because of earnings? What's going on here? Earnings don't come out till later this month. Is there some news on the stock this morning? Let me check my handy dandy.
It must be. That's quite a bit of volume.
But that sucks. Here if you have the stock and you bought into it anywhere in here, now it's all the way back to where you bought it. I actually remember we took a small position in this thing right around in here on a pocket pivot, didn't we? And then I didn't like the way it was acting, and I just unloaded it after it moved up a buck. And glad I did that. But this is this market. You got to be careful. You can get hit. Here and there with stocks, just out of the blue. It's just like out of the blue, it seems like.
See, VRX tends to be always sloppy, which is why I haven't really got all these pocket pivots. I haven't addressed because it's just very sloppy. It just violates its 50-day routinely. It doesn't really go anywhere. I don't, so for the stock to pull back like it did today, it doesn't surprise me. It just seems to be the nature of the stock. I checked for news just now. I'm not seeing anything on the wire. Mm-hmm. So it just could be the nature of the technical action that's endemic to this pattern.
Yeah, or somebody knows something going into earnings. I don't know. Maybe you'll find out later. Look around. Let's see if I can find another news source. We've got a bunch of them around here. Let me see here. Yeah, it's not really. Okay, here we go. They're presenting, I guess, at a Swan Global Healthcare conference, and I guess they don't like what they're saying. Maybe that's what it is. Somebody asked if the web.com group is a pocket pivot here. What's your take there, Dr. K? Or a viable gap up?
This stock has the pattern's always just been too slow and sluggish, and it's got some serious problems. If you look in July of 2012 or in October, I mean, look at those huge drop downs. There's something weird, maybe the way the markets are made in this stock. Okay, the second one is probably due to earnings, so that might be more just due to the earnings report. That's why it had a really wild day. But the day before, I mean the big drop before that happened in July, I don't like seeing that. And we've seen that with a few stocks, and it just makes me quite nervous because that's the kind of move that will shake you right out of the stock.
Yeah. So it's a little erratic, and earnings though look pretty decent. You know, up looks like they came out with earnings up 61%. So a little acceleration versus last quarter of 41%, but sales were up 51%, which are decelerating. Next quarter they're looking at 29% earnings, but somebody's buying it today, but it's just kind of a weaker stock. Can you comment on the intraday action on Chewy? You know, it's trying to go higher, but it's a really thin stock, so there's nothing, you know, there's nothing really to comment on other than the fact that it runs up and it's very extended, and you probably would run into some profit taking. So unless it's breaking down and issuing a sell signal, or you're getting heavily underwater on your position on heavy volume as it sells off, you know, there's really not much to think about. But it's extended, and it runs into some selling, which is not unusual for stocks to do, you know. So nothing really tricky here other than that it's extended. It's always interesting. If people are always, when something's going up, you know, in big streaks, there's never a problem there. But there's, you know, when something does something like this, you know, after it's gone up for a while, you have to discuss that. And, you know, it's just circle jerk type stuff if you're going to discuss it, because there's nothing really to think here other than the fact that, yeah, it gets extended. You can expect that stocks will run into some profit taking, and the thinner they are, the more of an effect that the profit taking is going to have. So not all that serious. We don't see it. Open Table. I use Open Table, but not a stock that we're looking at. How's this one look to you, Dr. K? You know, whopping. It's way down in its pattern. Look at this. Okay, let's look at the weekly chart.
I mean, it's a bottom.
Way down there. I'm not. You know, you're not going to buy this thing. No. So forget about it. Some of that's, and I appreciate your thoughts on X1. I don't know. I wouldn't appreciate our thoughts on X1 because they're kind of meaningless. What is there to think? You know, the thing comes public, it's running up for 2 days. Okay. You have no price history to make a decision on the stock. So what are you going to do? You're going to just start buying it willy-nilly, or do you think that we have some insight that we can convey to you that is going to make it safe to buy the stock here? I don't think so. I think, you know, X1 is just riding the hype and the excitement over 3D printing, which I think there are still a lot of issues with it in terms of its viability on a mass scale. You know, there's some specific areas where Triple D has been able to make some inroads on the consumer side with, you know, printing out little characters from video games and other stuff, but or you know, phone cases and stuff like that. But on a mass scale, where something like this has an everyday application, it's really not totally there yet. But I think it's there's going to be a lot of developments coming from this technology, and I think it will create more investment opportunities in addition to 3D and Stratasys. And I think it's nice to see another player come into the markets, because then you have more to choose from, and I think that makes it all more viable, the whole space more viable over time. So, but there's really nothing you can tell about it. What does the Stratocaster see having to happen to Apple to get back to shorting it? Well, you know what? It's running up, and I got to tell you, I think this stock is just kind of fun to watch on a daily basis, because it's getting really noisy down here. Because what happens is you have a bunch of dumb institutional investors who are buying the stock all the way down. David Einhorn, you know, I'd love to be David Einhorn to be able to get on Bloomberg TV and CNBC on the same day so I can pump my positions. You know, because then I'd go long a bunch of stuff and then get on TV and just pump away. And, of course, everybody reacts to him. Yesterday, Apple tried to go higher in the morning. Let's check out let's go to a intraday chart. And so you can see yesterday morning before the opening, so 6:30 a.m. is the opening on my time, and it runs up because David Einhorn gets on CNBC telling everybody how ridiculously cheap Apple is. And, of course, you know, he's the only guy who knows that. You know, nobody knows that Apple's ridiculously cheap, or thinks they know it's ridiculously cheap. But he said that, you know, that he's owned it since 2010, and Apple now constitutes a much bigger position than it's ever been for him, which tells you the guy's been buying it all the way down, or adding to it all the way down. And he's in it heavy now, so he's got to get out there and try and persuade the company to do something about the low stock price. And frankly, I think that companies shouldn't have to do something about a low stock price. If they want to buy back their stock, I think it would be smart of them to let it come down more, because I think it's eventually coming down lower, even if it does rally. But at the end of the day, Apple did come out and say they had completed, I believe, $10 billion of a $50 billion buyout program that they have, and so the stock jacked. I was actually short it yesterday, on this move, and was doing okay, making a little money, and then the thing just turns to the upside. But as soon as I know Apple well enough, and that when I'm short it and I see it start to move like this on a big green bar, I'm gone. I cover the position, I get the hell out of the way, and then wait for it to see what it's going to do. So it sucked in the sense that we were looking at a decent profit on a short position yesterday as it was coming in. It looked like it was going to come in all the way because it wasn't getting any traction, and of course another news event announcement from the company sends the stock higher, which now takes it above, let's get to the daily chart, takes it above the high of the range here. So we're using that as a trailing stop, now letting it rally. It's possible it could get all the way up to 480. It might just die right here. You're running into the 20-day moving average here, and that may be a stopping point. But what I notice is it's not getting huge volumes, 42% increase in volume. And I think it's still a weak stock, so I'm not a buyer of it. Although I have to admit, when it starts streaking to the upside like yesterday, I may turn around sometimes, and if I see this, cover my short and then just go long and ride the move up for a few points, which did happen yesterday. But in terms of a short, you need to see it run out of gas, and it may have to rally up in here. But we'll be watching it, and we'll put out an alert on it if we think we see something that's actionable. So, and you can test it. You can use our little handy-dandy intraday chart and try and test it out, when you get a sell signal. So right now, here you are. You've been running up all day, and now your 6 period is hanging out above the 20 period, and maybe you're going to roll over here, and you could test it out here using a move back up, the typical buy signal that we use on this 5-minute chart to get yourself out. So if it doesn't work, but that's one way you could test it if you want to test it into the rally. Regeneron is a stock that we've essentially blown off because we were stopped out of it a while ago, and it's gotten very erratic and don't really care for it. So there's really nothing to think here. I would not be buying the stock. Let's see. We're now in somebody says nothing has happened. I'm kind of losing patience. Should this be switched out with a better name? CTRX was downgraded by Wedbush. I think that's DGI. A lot of times you can lose patience with the stock and then it jacks out of there. So, I think with Digital Globe, if that's what you're talking about and you're just kind of bored with it, you can always blow out of it. But, whenever I do that, it seems like they go higher. Anyways, I'm going to answer a couple more questions. On just a couple more stocks here people are asking about, and then we're going to have to sign off here. Let's see, what do we got here? Oh, the question on Tree, they're clarifying, would you buy on the pocket pivot here? Is this today a pocket pivot?
If it can basically, it needs to, obviously, with all pocket pivots, not close at the low of its day, of the trading day. So earlier today, it was looking really good. Volume was looked like it was going to, volume should be sufficient. And this report, of course, comes after our prior report in mid to late January when it had the that move, the big move to the upside. And basically, if you bought this stock earlier and it can't close in a manner that is not at its low, then you might want to sell out your position by the end of the day.
Yeah.
Because that's a reversal, and that's a reversal on big volume.
On heavier volume, yeah, above it, well above average, and it's a thin stock. But that's the danger of buying these stocks that trade 200,000-300,000 shares, and I never get close to them. The last one we'll talk about, well, two more. Calumet is acting okay today, but it's a very volatile stock. I don't like this company. I don't like this stock just because I've watched it, and going into earnings, I think next week, and it's got good numbers. Sales are picking up the most recent quarter, but it's not widely owned. Only 41 mutual funds own the stock. It's a thin trader, it's acting okay, but it's a little volatile. If you own it, you can see. And, this sort of action might scare you out. Look at these big gaps in here. You don't like that sort of stuff, do you, Dr. K?
And no.
No. So I don't know. If you're owning it and it's breaking out, it's fine, but it's not something we would go for. Now, Yandex, Dr. K and I talk about this all the time. Is this the next, the Baidu of Russia? Well, Russia's got a lot smaller population than China does. I think, though, Yandex is coming out of a low position in its base, so I think there's a few problems with it. I think it needs more time. What do you think, Dr. K?
Yeah. I'm watching this one because it has a lot of potential. It tends to trace out like the RSX, which is the Russian stock market ETF. So it tends to outperform that. So if the RSX can turn around, move to the upside, which it very well could, since we're in the QE environment, then I think YNDX will outperform that index.
Yeah, I mean, it's one we're keeping an eye on. They got pretty good numbers in the most recent quarter. It was 62% growth. They're looking for 40% in the next quarter, and I think they announce when later on this month. So we're kind of keeping an eye on that. Anyways, I do notice that Amazon, which is my one little short today, is flaking out here. So yeah, so sometimes there are stocks you can go after on the short side, even as you're playing the long side, and I think you go for the weakest positions. The stock's rather in the weakest position. VMware is also a little cheesy in here. I still think that's shortable. Probably testing the position out. But again, if you're going to do this, use this chart. I think it's helpful for keeping you out of trouble. Like if you want to come after Apple, and I have to commend you for thinking about shorting Apple when the rest of the world is just so desperate to buy the stock right now. It just seems that way. And you got guys like Einhorn whining on TV that nobody loves their Apple position that's now gotten too big for them, apparently. But, if you see a breakdown here, let's say if you see a breakdown in VMware, you had one earlier, and now it's come back out, so you'd have to see another one later to come after it, and you might see that. So keep an eye on that sort of stuff if you're going to go after the shorts. And look at Amazon today, did actually, rallied above here, and it flakes out, and now it's moving lower. So if it busts the 50-day, which, let's look at which is very close to doing. The 50-day right now is at 260.36. I see the stock trading 261.04 bid. That could break down pretty sharply. And usually what happens is if it's a late-stage failed base, they head for the 200-day. That would undercut this low here. That would seem logical. And then you'll get a bounce back up to the 50-day. So we may be covering this in a short sale setup report later on. Anyways, that's all we have now, you guys, and nothing really more to say. Okay, one last question. ASGN, I don't know if you're using the 10-day moving average as your selling guide, I guess it violated it today, but I don't think you are. But other than that, it's just kind of flitting around here. Not a stock we own too thin. Anyways, that's all we got. We went on for a long time today, and maybe a little delay getting the video up today, just so you all know. But we will have it up at some point today. Just be patient. And as always, thanks for showing up, you guys. We appreciate you putting up with us for an hour or so, and we'll catch you next week.
So long, everyone.